Hi there, this is Stephen Gardner, best-selling author of A Bridge Over Troubled Wall Street. Thank you for checking out our online training today. Man, I am excited to go over this. We're going to show you something that it may blow your mind. If you're an Excel nerd or like to pull out your calculator, you can definitely go through some really incredible things. But we're going to show you what market loss can really do to your portfolio. And I'm going to show you some things that Wall Street does not want you to know about, okay? So again, thank you for being here today. On our last training, we talked about the importance of getting the highest rate of return that you can. But today, we want to talk about making sure that we're not chasing rate of return and make sure that we're not taking on unnecessary risk. Because one mess up can really, it can just devastate your portfolio. And so we're going to go through this training today. My book, A Bridge Over Troubled Wall Street, it covers a lot of this, but I wanted to do an in-depth training with you seeing my passion and my excitement for bridge plans and what we have to offer today, okay? So what we've done is I've done this. This is my handwriting. We've written everything out. I apologize if my handwriting is hard to read. That's my fault. But I wanted to get this out and show it to you. And what we're doing is we're showing $100,000 three different ways. Okay, we're going to show it growing at a consistent compounding 5% annually. We're going to show it growing at 7% consistently compounding. And then we're going to show 7% with just one market loss. And let me tell you, in the last 10 years, we've had more than 1 year of market loss. But I don't want to hit you over the head with a hammer. But I want you to see what just one market loss can do to really foul up your portfolio and ultimately your retirement. Okay? One thing to keep in mind is the stock market takes major hits on average every 7 years. Okay, think about it. 2008, back to 2001, back to 1994, back to 1987. I go over this in the book, but it's almost eerie how it's every 7 years. Here's another thing to keep in mind. We are 7 years out from the last market crash. Okay, so we saw this in 2000. We suffered losses, double-digit losses. In 2001, double-digit losses. In 2002, double-digit losses. Then the economy grew, everything was hunky-dory. 2007, double-digit losses. 2008, a 38% loss. From 2007 to 2008, over 52% loss for the average portfolio. I mean, can you imagine losing half of your wealth? Unfortunately, some of you may have. But anyway, let's get down to the numbers because this is really powerful. So what we're showing is we're just showing the growth of this over a 10-year period, okay? And we're not taking into account fees or anything. We're just showing this compounding and growing. So after 10 years, $100,000 at 5% compounding annually has grown to $162,889. I mean, that's spectacular. Now imagine if you continued to put money in every year and we just continue to grow and compound that inside of your bridge plan, okay? Now, again, last week we did a training where we talked about trying to get those higher rates of return. And with the bridge plans, we can get you 5 and 6. Occasionally, we can get you into a 7% contract, right? But at 5 to 6, you're earning significantly more than what the banks are doing. With a bridge plan, you can out-earn every bank product on the market and almost all annuities with the insurance companies, okay? You're certainly beating bonds and the treasury bills, okay? So let's now go through this. Okay, at 7%, you can see right out of the gate, we're earning more. And that higher rate of return is important because by the time we get to year 10, instead of $162,000, we've got $196,715. I mean, that's a pretty big difference. So getting the best rate of return you can is really good. If you've got money sitting at the bank earning 0.1% or less than 1%, my goodness, we can get you 5 or 10 times earnings doing the exact same strategy as the banks, using real assets, hard assets, physical buildings. We can get you those better rates of return. But now let me show you the devastation that comes from just one market loss. Keep in mind, we've had multiple, but I just want to show one, because again, I don't want to hit you over the head too many times with this. And make sure in my book, A Bridge Over Troubled Wall Street, you check out my market loss chapter on what it really looks like to lose money over a 20 to 40 year period. But also keep in mind the fee chapter in my book. That one usually explodes people's minds. They don't realize just how much they've been paying in fees. But let's go through this. So we're going to show this in the 5th year. We're going to show, you can see everything's consistent all the way up until we suffer a 20% loss. Okay, now again, 20%, I'm not showing outrageous numbers. This is pretty consistent, right? You can see it drops to $104,000. So basically, we have less money than we did before the end of year 1. So we've lost almost 4 years of time. But now you think about opportunity cost. I go over that in the book. But then just looking at the difference, look at this. We're now practically starting over. I mean, what a waste of time. What a waste of money. I mean, not to your advisor, they still took their paycheck, but look at this. By the time we get down here with one market loss, now instead of having the $196,715 that we should have had, we only end up with $147,076. That's a very big difference. And our job is to help you avoid that, to avoid the pit in your stomach, the losing sleep at night. We can help you avoid that. We've got to get risk out of your portfolio while at the same time holding on to good rates of return, and we can show you how to do that. But look at this. Look at even just the difference between a consistent 5% and 7% with just one market loss. That's a difference of $15,813. Okay? So with the 5% growth, you've had peace of mind the whole time. You've had consistent growth. You've had checks coming to either your home or the third-party fund custodian that we use to manage your IRA and qualified monies. You get that check every single month. I love it. I just had one of my clients email me over the weekend and say, hey, I just got my first 2 interest checks. He has two contracts, two bridge plans. And he said, it's so nice to finally be earning a decent rate of return again. Thank you, Stephen. I mean, I love getting emails like that. But so we've got to get that risk out of there. Now, one thing I want to point out, go to my fee chapter in A Bridge Over Troubled Wall Street. If you're in the stock market, you're working with a broker or an advisor, this does not take into account the 1 to 3% annual management fee. You're going to end up with significantly less money because they're taking money out every single year. Now, I don't want to put too many numbers up and confuse you, but I had my staff run the numbers before shooting this video, and with 7%, even at 1%, that's over $12,000 that they took out of your money in fees. So now imagine another $12,000 less. The thing I love about bridge plans is what you contractually sign up for is what you contractually get. That's including everything, all the fees and everything that are involved. So we're very transparent about that. I just want to show one more thing, because I don't want you to take everything that I'm saying as truth, even though I want you to trust me. But like Stephen Covey says, trust, but also verify. Okay? I want to hold this up. This is an article from USA Today back in March of 2014. and it says, lessons learned from 14 years of investing, right? And they call it 14 years of misery. And I know you won't be able to see this super well, but basically what it shows here is they did an in-depth study of the S&P 500 from the year 2000 all the way up to the year 2014. And what they found is that it actually only averaged 3.5%. And the article says, and that's including reinvested dividends. So you reinvesting your money every time you got a dividend, taking into account the market loss over those 14 years, you would have only averaged 3.5%. You might as well have been in the safest thing you can find, which is U.S. Treasury bills. And we would have been able to beat that. Okay? I've never lost any of my clients' money, and that has more to do with where I recommend they put their money than Stephen Gardner. But I want you to know we've done our research. We've looked for products that eliminate the risk, have multiple levels of safety, but are going to help you get to the next level, because we know that you have to beat inflation and you have to have that money. For heaven's sakes, you've worked so hard to get it. Now we need your money to work hard for you. So thank you for stopping by today to watch this training. If you have any other questions, please feel free to reach out to us. Our contact information is in our book, A Bridge Over Troubled Wall Street. You're welcome to email me, the author, directly at Stephen with a PH at yourbridgeplan.com. Please let us show you the contracts that we have available, all the safety features that our group has layered into this, and let us use contracts to get you the rate of returns that you deserve and eliminate the headaches and eliminate the pit in your stomach and the worry that comes from the losses that many people that I work with sustained multiple times. And so let's be done with that lesson and eliminate the risk. So again, thank you for stopping by and learning more about bridge plans and checking out the book. Have a good rest of your day.